Let's welcome one of our favorite market watchers, Jerome Hass, partner at Lightwater Partners. Thank you very much, Jerome. It's always great to hear from you. It's been a pretty good year for the TSX. What has jumped out for you?
Well, just how successful it's been. When you think about where we were in February or April, the market was very, very bullish. We were all concerned about the tariff war and what potentially the impact it would have in the Canadian economy. I don't think anybody predicted that we'd be up 26% year to date at this point. So, we kind of ask ourselves, why are we up so much? And I think that's the more fundamental question, not what the market is doing at these levels.
You're saying, though, in Toronto, valuations are stretched by any standard. For example, you reckon our beloved banks' valuations are near their highest in a decade?
Yeah, I think they're near 10-year high in terms of valuation. And I think that they all surprised the market last week with the Q3 results, or their quarterly results. So good on them for doing so. But valuations are definitely stretched. And if you look at some of the other segments in the market, U.S. tech has also done very, very well over the last 3 years. And you kind of go, well, how stretched do you really want to have the valuations? And on top of that, the inflows into that segment of the market have been phenomenal. And then you look at other segments of the market, gold is up at 4,000 right now. Do you really want to be putting money into gold stocks at these levels? So the question is, where do you put your money in 2026?
You have some stock ideas for us. The Atlantic magazine ran a story. Are we in an AI bubble? And it claims the entire U.S. economy is being propped up by the promise of productivity gains that seem very far from materializing. And they're talking about the massive investment here. Is that overstating it? I mean, obviously, they're being a bit rhetorical there. It's not the only thing in the U.S. economy. But is these productivity gains, they may be much slower than companies hope?
Yeah, I think so. What we're going to see is a lot of investment going into the infrastructure for AI. And we talk about the data centers, but are we actually going to see any gains from that? I think no, and I think if we do, it's going to take some time for them to come to fruition. And I think in your intro you were talking about Capital Power, an example, and I think there's a lot of enthusiasm has gone into that stock and TransAlta as well. That's perhaps getting ahead of itself in terms of them actually being able to deliver on these data centers in Alberta.
I wonder, I think I've said this on air before. If you run some kind of an electrical contracting firm, I guess you're buying yourself a Porsche this year. These guys must be able to charge what they want these days.
Well, yeah, I mean, really what the enthusiasm about those two stocks in particular is that Alberta has a lot of stranded gas. Arguably, we could argue we have the cheapest gas in the world, and it's stranded. So the ability of them to tap that for these data centers makes a lot of sense. It's great for nat gas, in the medium to long term in Western Canada, but we've got to get there first. And there's got to be a lot of capex that would go into this. And Canada being Canada, nothing's going to be built in a hurry here. So, when I look at those two names, we think they're overvalued, to be honest, at current levels.
You have, and we're trying to get hold of the Capital Power CEO, just get his analysis, because it is interesting, Ottawa watering down the environmental rules, and he sees it as a growth spurt for him. You have some ideas for a Cineplex. Now, investors were a little shaken to hear that Netflix might be taking over HBO, getting even bigger in streaming, and of course getting a Warner Brothers cinema business as well. Do you think investors are missing potential with Cineplex stock right now?
Last week, the stocks were up 5% one day, down 5% the next day, as rumors came in and out of the Netflix potential takeover. And then this weekend, there was comments by President Trump, largely in favor of Paramount, which is a rival bidder for it. Then overnight, Paramount announced a hostile deal for Warner Brothers. And this does have implications for Cineplex and the other cinema exhibitors in the States. And it's because Netflix is perceived to be negative towards the cinema exhibitors, whereas if they came in with Paramount, Paramount is viewed to be a lot more friendly in that regard. And so that's why we saw the bump yesterday in them. But coming back specifically to Cineplex, aside from all that, our thesis is that the CEO, Ellis Jacob, who's been there for 35 years, or in the industry 35 years, announced his plans to retire at the end of 2026. So he has strong incentives within his contract to sell the company before he goes. It's estimated that he can earn $12 million on a sale of Cineplex. And so we think the deal gets done before he leaves. And given that it's got 73% market share in Canada, I think it has to go before the Competition Bureau, which will take about 6 months. So you work back 6 months from the end of next year. They basically have to announce a deal by June of next year. So you got a pretty short window for these guys to be sold, if they're going to be sold. And we value it at $31. There's an activist fund out of Miami that's involved in the name. I think it's worth 31. It's trading at 11 and change today. We think it's pretty good risk return on a 6-month horizon at this point.
We're tight for time. You always bring us something new, Jerome. We're tight for time. DRI Healthcare. They're a royalty player akin to Franco-Nevada. They're in pharmaceuticals. I'm sorry we are tight for time, but tell us what's drawn your attention here, please.
Canadian investors love the royalty model in Franco-Nevada, which kind of pioneered that. What DRI has done is essentially applied that to the pharmaceutical and biotech space. And so to us, it's a really conservative way to play the biotech and pharmaceutical space. DRI owns a portfolio of 26 or 27 royalties, and they trade at a very cheap valuation, about 6 times EV to EBITDA. It's got about a 3.5% yield on it, and it's growing at double digits. If you're looking for something conservative to invest in that's got a yield in it, we think DRI is a pretty good name to be in. Plus, they have a history of special dividends at year end. So if you buy it before year end, you might get lucky and get a special distribution again this year.
Jerome, thank you very much indeed.
Thanks for having me, Andy.
Jerome Hass, partner at Lightwater Partners.